All right. Good morning and good evening, everyone. So before we get started, do you have any questions? All good? Okay. So let's see where we left off last time. So last time we were discussing the idea of continuous time model. Namely the Black-Scholes. Well, Black-Scholes doesn't have to be the only continuous time model, but that's the starting point. And so for any model, okay, for any stochastic model, um, one thing you want to pay attention to, or the main idea is there's always a kind of a source of noise. Or random source. Basically, what is it that drives the model, okay, in terms of its stochastic properties? So if you pay attention to that, it kind of gives a clue on how you unfold the model, how you understand the model. And for us, the source of noise is the Brownian motion, okay? So a lot of focus for us will be to understand how Brownian motion behaves, and then from there you can figure out how the model, the Black-Scholes model behaves based on the understanding of Brownian motion. So to recall, WT is a Brownian motion if it starts at 0, it has independent increment What this means is, suppose you have two time intervals, okay? Let's say R, S, T, U, okay? They are not overlapping. Then the increment from time T to time U is W minus WT. The increment from time R to time S is WS minus WR, okay? And again, so suppose a Brownian motion does something like this, right? So the gap from here to here is the increment. And so here, actually, the increment seems to be 0, right? Or Brownian motion did not increase in the net in that time interval. On the other hand, the Brownian motion curve done this, right? So then the increment WS minus WR will be negative, right? Of course, that's is overall a random quantities, both of them. And so the point is, if these two time intervals are not overlapping, then we must have independent between the increments, okay? So increments. So this notation means independent. Finally, the distribution of the increment has normal, is a normal random variable. So it has the so-called the identical distribution, identically distributed increment. So in other words, over any time interval, and so the statement here is just like this: WT minus WS has a normal 0t minus s distribution. All right. So for s less than t. So that's it. That's the definition of Brownian motion. And if this is the first time you see something like this, it may feel a little bit strange because how could these three properties capture something so complex? Well, the fact is it does. You just have to figure out other properties based on this description. So this imply everything else. Okay. But first of all, several remarks is really obvious, but it's worth pointing out. First of all, WT is a random variable. Okay. And so this fixing a t, okay, fixing a t, WT, fixing a time, and you just look at like the value of the Brownian motion at that time point, the possible values is a random variable. What kind of random variable is it? Is WT by itself has a normal 0t distribution. Where does this come from? It actually comes from point A and point C. A says W0 is 0. C says any increment has this distribution. So all you have to do is to choose S to be equal to 0. Okay, choose S to be equal to 0. Then here it says WT has normal 0t distribution. So Brownian motion by itself, okay, has a normal distribution. The value doesn't have, because the increment can be viewed as increment from time 0. Okay. B, that's fixing the time, right? So that's looking at spatial value. If you fix an event, fixing a path, okay, like a stop path, fixing an event in history, fix a path, then W, I say dot, right, is a function of time. Okay, so it's just a function of time, and that's why it's called a process. A process basically is a function of time. And you can draw that path. You can try to draw that path. But as most of you have seen, so that path starts at 0. Okay, that's all we know. And it does something. Actually, the behavior of W as a function of T is a much harder object to understand. But as you might have seen from the picture, it'll be something like this, right? A lot of jagged like movement. So it turns out that as a function of T, WT is very irregular. This path is something that is referred to as nowhere differentiable. Okay. In other words, if you remember, differentiability means that at a point you can draw a tangent line, okay, to the curve at that point. So tangent line tells you roughly how the curve is going to move in the next moment of time. So in that sense, the curve is at least regularly behaved around that point, because you can tell, roughly speaking, where it's moving in the next time moment. Something like this, right, is not differentiable at this point because you cannot tell where it's moving, okay, because there's no tangent line at that sharp corner. What it's saying here, nowhere means no point in time. That means that there is no point in time that you can draw a tangent line to the Brownian motion path, okay? Meaning that if you, so, okay, from far away, you might think that there's some kind of smooth movement or straight line movement, at least for a short amount of time. It turns out this statement, what it tells you is an illusion. If you zoom in far enough, then every point of the Brownian motion is a small corner, okay? Is that irregular? But anyway, combine A and B together, okay? Combine A and B together. It just says that W, right, or we just say WT, depends, well, so when we say W, maybe we just say W, okay? Is a stochastic process. And you probably have heard of this word before, but stochastic, right, just means random, and process means a function of time. And so this part is clear, right? Fixing time is a random variable. Fixing an event, right? Fixing a path, meaning fixing an event, or would people say fixing an omega, right? Fixing an event then it's a function of time. And so one more thing, what happens is that if you were to somehow draw the Brownian motion again, right, draw a different path, then you would definitely get a different picture from the previous one you draw, right? The path themselves are random objects, okay? So that's what these remarks together hopefully illuminate what the Brownian motion as an object means. What else? The independent properties, okay? The independent properties also has a interesting implication like this. That suppose you have the point S, okay? And let's say you have a T here, and let's say you have R here. So we think of, let's say S and T are fixed as a point in time. R as any point below S, okay? Then independent increment says that WT minus WS, right, is independent of WR minus W0. Okay, so we think of zero again as that invisible, starting point that we just can throw in because W0 is equal to 0, right? So the increment from S to T is independent of the increment from 0 to R. Okay, but of course, right, W0 is 0, so all we're saying is WT minus WS is independent of WR. This is for any R less than or equal to S. Okay, so starting from 0, if you want. Now, so notice that S is allowed. In other words, WT minus WS is independent of WS itself. Okay, so another way to say this is the future increment is independent of all the past history up to and including the current moment. Okay, so at the moment S, for example, right? At the moment S, suppose the Brownian motion is here. So the future movement doesn't care for whether that point is high or low, right? The future movement just move. By the future movement, we mean the net quantity, right? The net quantity that moves from time S to time T, the net quantity. That net quantity doesn't depend on how high or how low WS is, okay? And so the future increment is independent of all the past history, all the past history. So whatever the Brownian motion has been doing so far, it kind of forgets about at time S, right? In terms of the increment, all right? And then the future increment does not depend on any of the past history. So we capture that by, I think Professor Larson might have used this term, the so-called filtration notation, okay? FWS. So this is the filtration generated by W up to time S, right? So it includes all the sigma algebra generated by W up to and including time S, all right? Do not worry about sigma algebra so much. I will not use that in this class, but this notation, okay? I hope that if you want to make sense out of it, that's the sigma algebra that Professor Larson has mentioned before. So for us, right, all I want to use is this notation, right, means all the past information of W up to time S. Is that okay? So that notation. Any question? Okay. So then how to work with Brownian motion? So how to work with Brownian motion has many, many aspects. The first is the probabilistic aspect. In other words, we want to be able to take expectation and take conditional expectation with different objects involving bar motion. So for example, you have, I think you have worked on this before on your, review on your activity session, taking expectation, right, of the with respect to bar motion, things like this. Probability, let's say, E to WT is bigger than K. These are easy statements, right? I hope that everyone can figure that out. A little bit more sophisticated statement would be conditional type. Conditional type would be something like, for S less than T, what is the conditional expectation of E to WT based on all the past history of W up to and including time S, for example, right? What is this? Or, something like this may also show up, WT square condition on this, okay? So working with bar motion, first of all, involve understanding the probabilistic aspect of it and being able to figure out these kind of questions, which we'll discuss soon. The second part is the calculus part. So in a way, like a stochastic process is a function of two variables. The first is the random part, okay? And this is what we're talking about right here. The second is the T part, the time part, right? The time aspect part. How do we handle the fact that it's also a function of time? So as a function of time, it belongs to this so-called stochastic calculus, idea that we need to be able to integrate and differentiate with respect to bar motion, okay? And so this is a time aspect of it, okay? This is the this is the stochastic aspect. This is the time aspect of it. So for example, right, that, so by the way, this is really going to be called stochastic calculus or Ito calculus. And what is the use of being able to do something like this? The key for us, okay, is to be able to understand something like this. Remember, I say that the stock, right, the stock price, the Black-Scholes model will be something like this. This is the physical model, not the risk neutral one. Okay. But one thing, when you study math, all right, or when you study modeling, one thing you want to understand is, where does a model come from? What is the principle behind a model? Okay, so the question is why? Why do we build a model this way? Well, of course, if you want to work on certain other aspects, such as like pricing or stochastic simulation, statistics, whatever, you can accept these models as given and operate on the other aspects. But sometimes, right, the important thing for you to do is to be able to understand the principle, the motivation behind the model. And so the why, okay, is why does it make sense to build a stock model this way? And you probably got to admit that it's hard to see why. I mean, it's an exponential of something. Okay. Why does it make sense to model a stock this way? So for that, right, let's go back to the idea of a saving account to begin with. So let's go back to the idea of a saving account model, okay? Or money market account, right? And by the way, I'm referring to continuous time, okay, modeling. So compounding, the idea of compounding, right? The idea of how often you get the interest paid will be a continuous concept rather than discrete concept, okay? So for that, right, let's just say the money market account will have this model, right, where R is the interest rate. Yes, I think everyone will accept this. So the question is where does this model come from? I mean, right, you are in this business for so long, the exponential interest rate is just something you write down without even bother to question. But if someone asks you, why does the money market account behave this way? Or why do you model this way? Or why do you write down this equation? What's the explanation? How do you explain that? Anyone?
Doesn't the E exponential in this context come from taking the limit, like from the limit definition of E, and then you take the limit as like the incremental time steps goes to 0?
Very good. But limit of what?
It's like 1 over what 1 plus, or no, 1 plus 1 over RT, I guess, to the T, or to the RT.
Okay, so you have some idea, and I think that's very good. Actually, what you're thinking of is 1 plus R over N. So let me see here. R T over N raised to the N as N goes to infinity. And this quantity will be E to RT. Very good. But then again, the math is correct here, but then why? Or what is this? Okay, the limit is correct, but what's the meaning behind this? Why this seems to justify that, this is the case? I mean, I'm asking something obvious here, I hope, but the point is, right, or maybe I'm being annoying, but the point is, right, you just don't chase a formula. You want to be able to read what the formula is telling you financially or physically, whatever, right? Without being able to bring meaning to formula, a lot of things would just be a bunch of nonsense.
It's just a compounded interest rate model.
Correct, right? So this is like n period. Each period has length t over n, okay? And you compound n times. And so, of course, right, the idea of this is that you just push that limit, right? You push that time interval to 0 and you compound infinitely many times. And therefore, right, in the limit, this looks like this, and that's why you write like that. Very good, exactly. So now this is good, okay? But I would like to take a slightly different point of view, very similar. That is, so instead of doing this, right, I would like to do this. In terms of time interval, so consider, right, this will be very familiar to us. There's a t and there's a t plus dt, okay? So you think of dt as a small, okay, very small time, okay, length, very small. So what happens? I just consider my saving account and how much it has changed, okay, during that time interval. So of course, right, you recognize this familiar quantity. This is always referred to as the increment, the change, right, the net change from time t to time t plus dt. How much has the increment been changed? Well, Actually, here is very simple. What's my interest rate? R. So by the rule of saving, I should have saved, I should have been paid a proportion of my initial deposit at time t times how long I have kept that in the account. Is that correct? That's all saving means, right? And this equation, right? So this is the notation of approximation, because this only holds, right, for a short time interval, because R is meant to be, right, a very short interest rate. But of course, if you push dt to 0, then this equation gets precise. What do we mean by it gets precise? It gets precise mathematically by moving to this kind of notation. dmt is equal to r mt dt. Okay. Now, well, you still say that doesn't seem like something I know. Well, it will be if you do this. Because then you would recognize that this quantity is what, right, your calculus teacher would tell you as the derivative of m with respect to t. Okay. And so what you're into is something called the ODE, right? Ordinary differential equation. And so, in case you wonder why that is one of the prerequisites for the program, is because of understanding something like this, right? That ODE is just a very natural consideration for a modeling part where your time approximation goes to 0. Okay. So obviously, right, the whole point of you knowing ODE is that you know immediately, once you have this equation, the solution will be exactly that one that we wrote right there. Okay. So what we say, right, is this process right here of breaking time down to, time increment, analyzing the increment like this is called the dynamics of the process. Okay, the dynamic of the process, dynamics of the process, meaning we analyze how it moves in time, and it's the dynamics that tells you, okay, that tells you the meaning, the principle behind the process. And then from the dynamics, right, you solve for the explicit formula. And the key, right, you see the tool to go from the dynamics. Dynamics is the model, okay? Then that dynamics is the model. I mean, there's nothing wrong to call this a model, but I mean, and of course they're equivalent, and the equivalency is established via calculus. But right, the whole point is I maintain that the idea of the model is much better seen at the dynamics level, at the differential level, rather than at the explicit formula. Okay. And of course, that justifies us to understand, or it's worth our time to study calculus. Because when you build a model, okay, let's say you build something that has a rate of change following a different rule, you're not going to write down a formula and try to justify or try to check that the rate of change or whatever the formula you're writing down, agrees with what you expect. You actually start here, right, and put down the desired behavior, and then you try to see if you can solve it out explicitly. Okay. Any question here? So another way, okay, one more way that in our language that we can view the saving account or the money market account is this. This equation can be viewed as one more time another way as this. dmt over mt is rdt. Okay. Do you recognize this quantity and what is called in the financial term?
return?
Percentage return, right? Return is okay, but better is percentage return because, right? I mean, there are two types of return around, two returns around, right? So percentage return. So exactly, right? It says the percentage return of the money market account is exactly the interest rate. Of course, times, scale by time, because interest rate is usually quoted again, right, annually or something. So if you only save for 1 day, which is like 1/252, right, days in the year or something, then you're not going to get paid the whole 3%, but you're going to get paid a fraction of that. But right, this is percentage return. Okay, so that for me captures everything. So now going back to the stock model, right? The stock model. For me, the idea is also very basic, that it's an object that has returns. Okay, stock, or basically many financial assets, right? The one of the fundamental ideas behind it is returns, right? So you investors chase after returns, and in terms of modeling, you also want to look at the model, the returns model. So okay, now of course it gets a little bit more complex than that, but let's just say, what do we want out of, right, the percentage return of a stock model? Well, you see that, first of all, any stock has some kind of rate of return. And that's exactly what we would call mu dt, right? The dt, again, shouldn't be surprising to you because it's just a scale of time, right? Mu is, so let's say a company has 10% return rate per annual, right, annually, then dt would scale it down to a daily factor or whatever that is that you're looking at. But of course, doing that would make it awfully, right, similar to a saving account, which has a higher interest rate, which is of course not what you expect when you think of a stock model, right? The whole point of a stock is that it has some stochastic component, okay, that cannot be quite grasped or something. So how do we model that stochastic component? Well, you see, so to be fair, usually people just do that, plus noise, okay, plus noise. And exactly how you insert the noise in here kind of defines, right, what model you're using. So of course, the noise has two parts, right? The noise, when you look at the noise, you have, they call it the location of the scale, right? I'm using statistics language here, but anyway, mean and variance. The location, the mean of the noise, actually, it goes without saying, it should have mean 0. Because, right, the point is the noise should not drive your model, right? The noise is just going to be fluctuation. But so adding the noise on average does not change the trend. So the noise on average should have mean 0. What about the variance? Well, there are two parts to the variance. First, the variance should also depend on time, right? Because again, the idea is for a short amount of time, you should not suffer so much noise, but for a longer time, you should have a longer more variation in noise, right? So this noise, the scale here should be also depending on time. So the scale here, at least is reasonable that it should be proportional to dt, right? The length of time in terms of variance. But also there's an intrinsic component to the company, right, that you felt deserved to be singled out. In other words, different companies may have similar noise behavior, but they also have their intrinsic level of risk, right? So that exactly is designated by a sigma out there, okay? This sigma, so there's a noise that has a scale by itself that deals with time, right, with the scale of time, but there's also a sigma that magnifies this noise that kind of is intrinsic to only the company itself, okay? So that's that, sigma times that. Okay, but then what is a good choice for this noise? Well, you see, it's no secret that is denoted as DWT. Okay, DWT. So DWT, again, you see now you want to go back and try to understand, okay, with my understanding of DWT, why does this make sense as a model, right, for the noise? Well, DWT, remember, is just a stylized, I mean, it has its own precise meaning, but right now, right, it means the increment of the Brownian motion, okay? So for all intent and purposes, you are encouraged to think of this as the increment of the Brownian motion over a very short amount of time, okay? So then remember, what is it? This guy is a normal random variable with mean 0 and variance equal to a length of time, dt, right? Which is this minus that. So there, right? It satisfies exactly these two desirable properties that I talked about in terms of, proportion in time scaling factor. But not only that, okay? Notice that this guy are independent as long as the time intervals are not overlapping. So in other words, right, the noise or the shock that my returns are subject to today is independent of the shock that I'm, subject to tomorrow. It seems okay, right? So in that sense, the independent increment also is a bonus that, frankly speaking, makes a model easier to work with, but also, seems to accord with reality. Seems to, because you can easily come back and say, I don't believe so. I say, I think the shock tomorrow has something to do with shock today. I'm not going to argue against that, except that that's going to be a different model, different source of noise we're modeling. Okay, but I would just say, starting out, it seems reasonable, right, that independent noise is okay to work with. Also, right, do pay attention. That doesn't mean the stock price itself are independent. Okay, the stock price next day definitely is not independent of the stock price today. If stock price today is high, more likely than not, stock price tomorrow is high. The returns, okay, pay attention, the returns are independent, not the stock price itself. So it's very important for us to draw, to distinguish these two concepts. All right. So that's a long story to explain, right, the dynamics of the Black-Scholes model. And I argue that the Black-Scholes model makes the most sense at the dynamics level. Any question? Okay, but notice, right, of course, again, when you have a model, right, dynamics, there's always that desire to recover it. In other words, going back to the explicit representation, because I would say, right, you want the explicit representation at a more advanced level. Is not a must, okay? It's not a must. But right now, I think, let's say it's very desirable to have such a thing because, again, right, this is a model for the returns, for the dynamics. But for other reasons, we definitely want the direct access to the stock price. For example, pricing option, right? Option is not an object that's priced upon the returns. Option is an object that's priced upon the stock price itself, right? Price. So therefore, if you don't have a direct access to stock price, pricing option is going to be awkward or actually, much harder. So the link, right, between here and here is the question, right? How to go from here to here. And if you recall, right, the link without this part. So actually, one thing, imagine if sigma is equal to 0, right? If sigma is equal to 0, then we turn off the noise. Then notice that exactly these two parts get turned off. And this is nothing but the glorious money market account. Okay. So the addition of the Brownian motion part makes the model, right, more complicated, more interesting, and of course, actually models the stock rather than the money market account. But from some point of view, you see it's an extension, right, or a generalization of the money market account model that you're so comfortable with. All right. Now, what else do I want to say here? Yeah. So another thing is this, that right, so how, right, how to go from here to here. And this again, right, is the idea of stochastic calculus to tell you how to go from here to here. All right. One thing I want to explain also is the idea of the Brownian motion from yet another point of view. Another point of view is, where does the Brownian motion come from, or why does it make sense to model it like this? Now, if you take classes in other areas, like regression or statistics, the normal random variable shows up a lot as well. Okay, so people are basically in love with the normal distribution, right? And you got to ask the question why. So several reasons. First of all, normal is easy to work with. It has very nice properties, but behind the scene, okay, one of the appeal for the normal random variable is the so-called central limit theorem, right, which we kind of mentioned quickly last time. Central limit theorem basically says that if you mix, right, independent random variables in terms of addition, then the outcome, right, the sum is approximately normal if the sum, right, if you have large enough quantities of sum. So this right here, okay, can be understood as the result of all the actions of buying and selling on the stock. Okay, so you imagine, right, that every time a trader buy or sell the stock, it will have an influence, okay, on the stock price, up or down, whatever. But of course, at the modeling level, we're not going to be able to chase and track down the behavior or the action of every single trader during that time period. But of course, right, the stock price during that time, right, trader A, trader B, up to trader, I don't know, a million, make independent actions on the stock, which each of which, right, has some small action on the stock price, some more effect on the stock price. The net stock price, right, the final result is going to be the average of all those small results. So the central limit theorem says that, well, if those actions are independent and they're kind of similar, then the net result will be a normal change, okay? Normal meaning the normal distribution change in terms of the stock price. And so this also has the idea of encapsulating all the trading action of the trader, okay? Or of the market, let's say, right, upon the stock. All right. So, okay. All right. So let's continue with the idea of stochastic calculus. Any questions so far? All right. So yet another piece of the puzzle that I need to mention, and that is the so-called log returns. Okay. So log returns, if you remember, is the change in the log price, right? Log returns is basically natural log. Okay, so this is log returns over a short period of time. Okay, now by the definition of the log, right? Log of the ratio is the difference of the log. Okay, but of course, in the short time interval, remember, when we have something like this, whatever this object is, right? Basically, you evaluate this object at t plus dt, and then you evaluate this object at t. So that is nothing but the increment of whatever that object is in terms of time. And the object is the log price. Okay, just almost by definition, that's what we mean when we say, the increment. So actually, this whole maneuver right here tells you that the log returns is close to the log price change in log price, right? Log price means log of price. The log returns is close to or is equal to the change in log price when time is small, when the length of time is small, when the interval is small, okay? But then, right, so on the other hand, the log returns is a kind of returns. Oh, by the way, sorry, one thing I want to say here as well. The implication here, right, is that obviously the percentage return is a random variable. Okay. The percentage return is a random variable. What kind of random variable? In terms of random variable, also do understand this message that the percentage returns here will be a normal random variable with mean mu dt. That's the average return rate. Oh, sorry, that's average return, right? Return rate is mu, but this is the average return. And the variance is sigma square times dt. Is that okay? So this also has that message. And again, it perfectly is acceptable. When a trader, an investor, look at their percentage returns over a short period of time, right, they expect some kind of average return and some kind of variance, right, fluctuation around that level. And here, the models just kind of, I would argue that it really accords with reality, that it says, right, the average return is mu dt, the average percentage return, right, and the mean average, and then the variance is this, scale with time. In terms of percentage return, right, it also has an average rate of return and also has a variance. The variance part is this, no problem. But I think from the homework, you might have seen that the average, right, return, the average log return is lower than the percentage return, okay? This is mu, and because sigma square is positive, this is lower than that, okay? So it still has a rate of return, but the rate of return in terms of log returns is lower. So obviously, you know, there's a question here on why, okay? And the why here is not, you know, some mysterious reason or like the trader wants to cheat you and wants to report one thing for one object and another thing for another object, okay? But, oh, sorry, so I mean the link is from here to here rather, but I guess you can say link like that. The point is, right, that is, I mean, the non-explanatory answer, but yet still slightly correct, is that, well, it's because of how you calculate the returns, okay? These are different mathematical objects. One is the log, one is, you know, the percentage. Surely, right, at the differential level, they have slightly bit different behavior. And exactly being able to figure out or nail down exactly why that happens, okay, is the goal of stochastic calculus. And finally, you see this is exactly that. So the stock price itself inherits, right, that object, that mu minus 1/2 sigma square from the log returns, okay? So in some sense, the log returns at continuous time level is a more intimate object than the percentage returns, okay, in terms of like connecting with the price. But again, right, why? These three representations, they're all equally valid. They all tell their own story. And we want to understand the connection between them. Again, that connection is stochastic calculus, okay? So that's the second piece of the puzzle. Then of course, right, after you do that, then the third piece of the puzzle, so you understand the probabilistic idea of the model, you understand the stochastic, the calculus idea of the model, then you go on and price, right? You do the finance, you do the pricing part. And pricing, of course, has its own, you know, peculiarity that we want to discuss. But pricing, you know, if I really want to cheapen it, right, it boils down to some formula at first sight. What formula, right? So you have your call option, let's say, right? VT is ST minus K plus. Okay. So notice, right, that what have you accomplished so far? Let's say you work at a company, right? Then probably your boss will give you a question like this to begin with. Price this. Here's a product price. So your job as a quant or something probably will have to go back to the table and say, okay, what model do I use? How do I model the stock? How do I model the object underlying? And then how do I understand, you know, its behavior, its stochastic properties, And then after that, I plug that model into, the product that my boss wants me to price, and then apply the pricing principle to price it. Okay, sounds easy, right? No, not really, because the whole point of modeling may get super complicated if, right, the underlying is not stock. If it's a stock, okay, no one will blame you if you use Black-Scholes to begin with. But let's say the underlying is some kind of index or some kind of, I don't know, mortgage rate or something, right? Then I'm just telling the stories, right, of security, but from Math Finance 1, you've seen fixed income and then foreign exchange, right? Each kind of market or each kind of product requires some understanding in terms of the finance to bring out, right, the modeling idea. But anyway, right, so the problem starts here, but you have to go all the way back to the modeling stage to bring it out. But suppose that after you work on all those things or have done your research, right, you understand perfectly what this object behaves like. Then you apply the pricing principle. Namely, you got to convert that to risk neutral framework. So in terms of risk neutral framework, we will explain this, okay? For now, I'm just gonna operate on this and explain it later. But the whole point of risk neutral pricing is that at least, for the Black-Scholes model, is seems like a superficial change of the mu to the r. Okay, so here, right, is mu, here's r. But beware, all right? I mean, if you were to do expectation, that's probably all you care about. But in terms of meaning, it has a deeper meaning because the two prime motions are not the same. It's this WT and this is W tilde T, all right? WT is a prime motion under the physical measure. W tilde T is a prime motion under the risk neutral measure, okay? But anyway, in terms of expectation, as I said, it doesn't matter. Prime motion, they behave in the same way, probabilistically. So you do that and you plug that into here, right? And you do the pricing formula, which is this. Okay, and then you get your glorious Black-Scholes formula. Okay, so this is some work, right, in and of itself. I'm not saying it's trivial or anything like that. You could easily spend like half a lecture, I mean, 30 minutes, right, trying to explain why this comes out. But of course, I trust that you guys are sophisticated enough to work out these calculations by yourself, of course, with guidance and hint. Yeah, question?
This is the first problem in the homework one.
Yeah, but of course you have a hint on a simplifier problem, right? That I hope you work with the TA on. And from that simplified problem, you can convert it to this problem, and then work it out. But my point being, right, is that I know that you pay me a lot of money to teach you, so you do not want your money spent on me teaching you something as mundane as this, right? My job is to try to show you how you get to this stage, okay, at the stock pricing building model, and then from there, right? I mean, you take it home. But the calculation aspect, of course, has some interesting part on it, but it's not super hard, right? Of course, I don't want to say the pricing aspect is easy either. But okay, so 3 stages, right, that I would like to kind of go over and discuss in details, right? And anyway, that's the process. And then we will go back to each stage and fill in the details more and more as we go along. Any question? All right. So no question, right? So I want to throw in 4 the coding simulation part. Obviously, something that I keep saying that this class should be demonstrated, right, with this. So it brings to life all this concept a little bit in some other ways. But basically, coding simulation is just trying to do the math, right, that we spell out here on paper on the computer. But what is the idea here I want to tell you to begin with? So one idea, which sounds too simple, but basically stochastic integration. Okay, let me say this. Is approximately sum when dt is small. Or actually, that doesn't have to be stochastic. Any kind of integration is approximately sum when the differential is small. Well, case in point, I'm not sure Professor Wu Jun did with you last semester or this semester or something, but I'm sure you are familiar with this kind of thing. Yes, I hope you've seen this. This is just Riemann sum, right? And approximating Riemann integral. Okay. So, all right. So, of course, if you pay attention, right, the idea behind this, by the way, is this, that by writing something like this, all you're saying at some point is that dft is ft dt. That's what this is saying. No. What am I saying? I'm saying something nonsense. I apologize. What I'm saying is not DFT, not DFT, of course. What I'm saying is, let's say the object that you're looking for, okay? Let's call it L of t, I of t, I for integral, okay? I of t, the integral, right, is the integral from a to t, let's say of f of s ds. Okay, and of course, right, you want to look for I of b, the integral at b. Yes. So basically, the idea is the change of this integral at any time point is ft dt. That's the idea. Well, why? I mean, I hope it's clear to you that, by being an integral, right? Let's say here's a, here's b, here's t, right? So what we were saying above is that we have had an integral up to this point, right? This is what we call, this object is what we call I of t. When we say di of t, what we mean is, let's just increase it a little bit to this time interval, right? And of course, our integral, right, will pick up this new shade. But this new object is exactly, right, di of t, right? That new area that we pick up by moving time from t to t plus dt. But what is this? Well, because roughly is a rectangle, right? Of course, the graph here is the graph of f of t. So this is nothing but f of t times how long that length has passed, which is ft dt. Okay. And so notice, right, in effect, what you're doing is like a telescoping sum, because what you're saying is something like I at ti plus 1 minus I of ti is approximately f of ti times ti plus 1 minus ti. That's right here. Okay. So you see, when you sum all these guys up, all you're doing, right, is summing I of ti plus 1 minus I of ti for I runs from 1 or 0, whatever, right, to n. Right, that's this sum right here. But you see that all you do is something like I of t1 minus I of t0 plus I of t2 minus I of t1, right? So on and so forth. And then plus, I of t3 minus I of t2, right? So all in all, you see I of t1 cancel with this, right? I of t2 cancel with this. So eventually, when you sum all this up, what you get is I of tn minus I of t0, which is really, I of b minus I of a. So that's exactly right. Obviously, so I of a, because of our definition, right? I of t is from here to here. I of a is 0, right? I of a is 0. So therefore, this is exactly the integral that we're looking for. Okay. So how to say this, right? That this is a little bit long-winded speech, but to explain to you that in reality, a lot of times when you see a fancy integration notation, all you're doing is adding, okay, in real time. Obviously, of course, you take numerical analysis not to, be told that that's what you do, but the point of numerical analysis is to ask, okay, how good is this process? When I push time to 0, do I always guarantee get guaranteed conversions? Is there anything wrong going on, etc. Right? Of course, Professor Wu Jun is an expert on that. He can tell you everything. Here, I'm just really telling you that here's a simple procedure that you can apply in reasonable cases. Okay, and let's just stay with that. And so, but the point is, right? You see, I want to say this: when you have something like this, to recover this, all you need to do is add. That's the message. All you need to do is to add the differential. Okay, that's the message. So let me say again. So the message is to recover, right? To recover whatever you have. Let's say this. All you have to do is add the differential. Okay, so the big increment is the sum of the small increments, or as we call it, sum of differential. Is that okay? So that is as simple a message as possible, and it's true by definition. Okay, it's true by definition. But in practice, that's what carries us, at least in the initial stage of integration, of simulation. How does that work? For example, right? How do I simulate the Brown motion path? Okay, when you think about simulating a Brown motion path, it's not that easy. And if you simulate it in an arbitrary way, you're going to get a wrong object. The Brown motion path is a very complicated object because it's a stochastic path that has intimate connection between its points. So what you need to do is go back to the root of it, which says that Brown motion is ultimately starting at 0, is composed of blocks. Okay, so each block right here is an independent normal. So these are the so-called DWT, right? The increments of the Brown motion over this time period, over this time period, over this time period. So using our principle that WT, right, or rather, right, WT minus W0 is the integral from 0 to t of dWs, right? To get the big increment I just add the small increments. So of course, W0 is 0. In a computer, okay, what I need to do is I need to simulate an IID independent normal. Okay, simulate n IID independent normals with mean 0 and variance dt, where dt is that small time interval that I care for. And if I patch them up like that, if I keep adding these increments, then I get my Brownian path. Okay. How do I simulate my stop path? Well, for once, right, you got DST, right? So DST, the percentage returns, say DST over ST is mu dt plus sigma dWt. Okay. So I like this language because it's percentage return, but a lot of time you will see something like this. Again, it's equivalent because basically you just bring ST over here. All right. What this says though is it tells you the differential of the price. It tells you how the price move in the next time moment. Financially, I'm not sure if it means so much because people, again, don't care about price change. People care about percentage return, right? But mathematically, actually, it helps us a lot if we want to track the price. Because remember that the stock price, follow our principle, is the sum of its differential. Okay, so basically, again, all you do is sum, basically mu, right, STI delta TI plus sigma STI delta WTI, I from 1 to n. So what you do, right, is you basically take the previous stop point times how long time has passed, which is dt. Take the previous stop point times the change in prime motion. That will give you the next stop point price. Okay, and when you add them up like that, you get the stop price path. And the principle is very much like the prime motion generation, except that right here, the increment depends on the previous point. Okay, depends on the previous point. So you need to take care of that. Finally, so that's simulate the stock price path and the prime motion path. Finally, in terms of pricing, okay, for pricing, the object is to compute V0, which is expectation of e to minus RT, right? ST minus K plus. You have two ways to do so. The first way is just to apply the formula. In other words, right, you just plug in this formula right here with all the parameters that's given. So this is the analytic approach where everything is cooked out for you. Everything is precise. There's nothing approximating here, right? Everything is precise. But of course, do realize that, for a simple product like a call option, yes, there's a Black-Scholes formula. But very soon you will see that if we move to, like, say, an exotic option, like an Asian option or a look-back option, then something like Black-Scholes formula is no longer available. Okay, because the expectation is much more complicated. So the analytic approach, while if you have it, is very nice and you can do a lot of things with it. In reality, right, it is not universally applicable to many problems in terms of calculating the expectation. So the second way is an approximation. But it basically, in principle, allows you to approximate anything you care to do. So how do you simulate here, right? The idea of Monte Carlo simulation, again, is some kind of average where, in some way, this is like summing up in time. Expectation is summing up in terms of events, okay? So in other words, what you do is you pay attention that ST right here, this object is this. So all you have to do is, right, follow the principle we discussed last time, simulate this Brownian motion part, because that's the source of your noise. So it's like you simulate, right, 1,000 values, let's say, of WT, which nothing is just basically, normal 0T. So simulate 1,000 normal would mean 0 and variance T. Then, of course, from there, you can get 1,000 values of ST, which gives you 1,000 values of VT, right? So then this expectation basically tells you that go ahead, and so this is VT, right? Go ahead and discount it and average over 1,000. So the answer will be V0 is approximately, right, the sum over e to minus RT of 1,000 values of this VT divided by 1,000, which is your, the number of simulations that you have done so far for the stock price. Any question on this? Okay, so again, right, this, of course, the simulation is interesting in and of itself, but actually the simulation, as you can see, brings illustration to the math, the abstract math that we'll be doing later on as well, especially the summing, right? As you see that when we do stochastic integration, stochastic calculus, it's nothing but makes sense out of all this summing in the continuous time. So let me show you the code, right? The code has been posted online. So let's see, on Canvas. All right, so here. All right, so first of all, the simulation of Brownian motion path. So this is number of time steps. Okay, I do 1,000 time steps. Could be 1,000, 100, whatever. Okay, let's say 100 time steps. So this is dt right here. Okay, which is how big my time step is. I define all the parameters. I don't need to define R here if I want to simulate, the physical rate. These are just some other return and sigma that I want to simulate to show you the difference in the two stock prices with different mu and different sigma. So here, right? Let's see. Right here is exactly where I simulate the DW that I tell you about, right? So this simulates, like, here, I guess 100, right? Independent normals with mean 0 and variance dt, right? So this is the standard deviation. That's why square root. Okay, and then you see, then I just go through the time, and I just keep adding, right? I keep adding the differentials to the previous time point. And now in doing that, I generate my Brownian motion. Okay. Now here, what I do is I generate I show you two different ways to generate the stock price path. This way is just the direct formula, meaning this is the exact formula, okay? Because I just use the formula, right? S0 e to the mu minus 1/2 sigma squared times t, right? This is dt times time is t plus sigma times wt. But the alternative way is the differential way, where you see here, right? You see I keep adding. This is what I told you. I keep adding, right? The new stock price is the old stock price plus its differential. What is the differential? The differential is the previous, right? This is st, right, times mu dt plus sigma dwt. Okay. So the point is, right, to show you that these two path prices are the same. I mean, not the same, they should be very close when dt is small, right? That's the whole idea of calculus. This is the exact formula. When you do this, you are approximating it using numerical procedure. But if the calculus is correct, right, then these two should be converging to the same path. And finally, this is just another path. Oops, I should do S3. So let me post this again. I think I post the old wrong version. This is S3. This is just basically generate a new stock price path that is similar to what it has the same starting point, which is 100, but has different rate of return and different volatility, right? And so let's run it. And you see, right? So first of all, the path is a little bit jagged. Okay, let me the path is a little bit jagged. So this is Brown motion path, stock price path, the two stock price path, right? Also notice that the percentage return path doesn't look similar to the explicit formula path. Why? You can argue that because the approximation is not good right now, because dt is still too large, okay? Well, here dt is 0.01. In the realm of thing, that may still be too big. So let me turn off the third stock price. We'll do it later. So let's make the dt smaller and compare. So you see how, right, these two paths are more similar. Okay, let me plot them on the same plot, so for you to compare. Okay. So now I will plot the two together. So they should be, right, superimposed on each other. Now, do pay attention, right? The significance of this is I'm not exhibiting the same path, the same graph to you again. These are two paths generated by two different ways. One is the explicit formula. One is the differential approach. That's where calculus comes in, right? If your calculus is correct, these two should be the same path. Should be similar path when dt is small. See, when I superimpose them, you don't see anything, right? Now, let me again, right, make dt smaller and to show you that the approximation is not good when dt is small. Oh, wow, hold on. Yeah, you see, maybe here, right, they deviate, but somehow at 100, somehow it seems to be good already. Let me see, run again. Yeah, at 100, it seems to be good already. They seem to be quite superimposed on each other. Okay. So let me do it at 1,000. So one more thing, right, which I guess I didn't mention is this is the Brown motion path. You see that every time I run it, I get a different path. All right. That's what we mean when we say, right, the Brown motion is a random object. Okay. Every time you run it, it starts at 0, but it's a different path. Okay. And of course, right, if you really pay attention to a time like right here and you record all the change at that time, right? I mean like for different paths, these have different values. Then when you record that, you'll get a normal random variable out of it. So let me take out this. Another thing to pay attention to is this, that it may look a little bit suspicious, right? That somehow the stock price path and the brown motion path looks very similar, right? The stock price path and the brown motion path looks very similar. Well, that actually, so when I simulated it, I felt a little bit suspicious, but actually that's, I guess, to be expected. Why? Because you see, ultimately the stock price, right, is exponential of the brown motion. So exponential being, you know, a increasing function, right? If the brown motion decrease, then the exponential decrease. If the exponential increase, then the brown motion increase. Sorry, if the brown motion increase, then the exponential increase, right? Of course, there's still the idea that the mu minus 1/2 sigma square part, you know, may somehow contribute, but the contribution of this is more in terms of the scaling, and it doesn't really affect the qualitative behavior in terms of, you know, how these two guys look, you know, the same. Of course, right, that's just in terms of the up and down. If you don't notice that these two guys live on two very different worlds, right? This is at the scale of 100. This is at a scale of, you know, 0 to 1, right? So for example, if you superimpose these two guys together, you see that it just doesn't look like anything, okay? So the scale-wise, they are very different to begin with, right? This is your brown motion right here. This is your stock, right? So it's not the same in terms of scale to begin with. Just qualitatively, they look similar, okay? Second of all, right, to show you that the effect of, right, mu and sigma is there, that's why I plot the S3, right? The S3 is to show you that, yes, there is a change. If you have different mu and different sigma, then, you know, the path do look different. So let me bring out the S3, okay? You see, right? So even though, right, in some way you can say that this path, these two paths look similar to brown motion, right, in the naked eye, but superimposing them, you see, then you won't say that's their path, right? So that's the idea, that the mu sigma effect are there, but when we compare them, you know, at some macroscopic level, sure. And so that's the idea, right, that the brown motion is the driving force, right, the driving noise of the stock price path. It really influences how the stock price moves very strongly. Now, of course, when you have two different companies, you can argue they are driven by the same brown motion, or they're driven by independent brown motions. And that's an interesting idea, right? So basically, if they are in different sectors and they're subject to different kind of actions, market actions, then maybe it doesn't make sense for you to use the same brown motion to model those two different companies, because you see the net behavior is maybe that you will have two behaviors like this, right? Maybe different in scales, but very similar in terms of price movement, which may be acceptable, right? You see actually a lot of stocks these days, if they are in the same sector, like blue chip, whatever, right? They tend to move in very similar ways, just different scales. You know, this is like obviously highly correlated stocks. If that's what you think that's going on, go ahead. But if you really want to separate them out and just say have a smaller correlation, then you want to use a different brown motion, right? Or maybe an extra brown motion source to add to this, you know, behavior of stock. Any question on this? Okay. You can play around with, right, many of these things. For example, right, how would the stock price, how would the path move if you make the sigma really high, right? What if you have a really high volatility stocks? Also notice, right, stock tends to, I don't know, maybe tends to go up is not right, but if you make the volatility really high, right, you may observe something, right? This is a high volatility stock, right? And you see, notice the old one is still at 0.2, right? And this one has 0.8 volatility, 80% volatility. You see, so over this interest period of investment, maybe 1 year, this high volatility stock has really good returns, right? Beat out on this one. But of course, right, it's high risk. you simulate a few more times, there will be some times where this guy will really tank, right? And then this guy will be more mild. But again, right, these kind of things you can see from changing and playing around with the volatility. And of course, the rate of return as well. Okay. Questions? Okay, so next, this is the pricing, right, simulation. So again, right, there are two things we want to do. When you do math, right, it's good for you to pay attention to several ways to do the same thing and compare and contrast them to see what you can learn. So here, right, there again, there are two ways. The first way is just to do the Black-Scholes formula, which is, compute d plus, d minus, right? This is to compute the nd plus, nd minus thing. And so where is it? Right here, right? S0 nd plus minus k e to minus rt nd minus. So that's the Cole-Black-Scholes function, right? So I do the Cole-Black-Scholes function, I plug in the parameters, I get the price. This price is exact, okay? It will never change as long as I keep the parameters the same. On the other hand, what I could do is I could simulate, like you see here, right? 10,000 normal random variables, and that stands for my WT. And then I can simulate, right here, 10,000 values of ST. And then I simulate, right, the payoff divided by N, discount, and I get an approximation price. And see, right, this approximation probably one can say is pretty bad because, right, the error is 10% from here to here, right? This is the exact price. This is the approximation price. But of course, if you run again, let's see, you get this, run more, oops, right? It's pretty stable, but it doesn't seem to be a very good conversions. I don't know. I'm surprised by the conversions, by a terrible conversions too. I thought it should be better. Let's do this. And 100,000 already. Yeah, I'm not sure. There's something off here, but let me see. Wow. I'm curious if there's something wrong with my code because the conversion is not bad. Okay, the conversion should not be bad, but like the fact that it does not even come close to this means that something's wrong with my code. Anyway, I will look back into this, but that's the gist of it. Okay, I'll see if there's something wrong with this. It should be close to this already. Like it should not be 1% error like this. But the point being is that, the second approach, right? This is much more flexible, even though, right, the cost you pay is some kind of small error. The key, right, the thing you want to learn when you do simulation actually is not just do this, but how to speed up conversions. Because, writing down a million simulations like this is pretty silly, okay? I think maybe 10,000 simulations something is okay. Of course, sometimes if you have to run 1 million, you run it, but not for a simple calculation like this. So in practice, right, there are other ways to write the simulation to speed up the conversions, okay? Like, using some correlation structure for your simulation that drives the conversions faster. That's not the point of this class, right? The point of this class is to bring out the techniques to show you and then to highlight, right, the math behind it and that kind of thing. But if you are interested in, learning more about Monte Carlo techniques, I think Professor Lawson's class, right, is the one for you. He may tell more about like how to make the conversions faster and that kind of thing. So that's the topic of such a course, right? Same thing as like with integration, you want to make your integration more precise numerically, then Professor Wu Jun's class is for you, right? But at least, right, get the idea that you can just sit down and write a very quick code to do some calculation for yourself, right? There's some error there, etc. But overall, if you don't worry about it so much, you just want to learn about the model firsthand, then something like this can be useful. Okay. Any question? Okay, so I think it's probably a good place to stop. I mean, to take a rest, take a break. So let's take a break for 10 minutes, okay? I just want to kind of glance at this code a little bit to see if I did something wrong. Let's resume at 10:20 my time, okay? Okay, see you then.
Okay, see you later.
Yeah. All right, I'm back. So first, let's kind of go back to this simulation again. So I, I don't think there's anything wrong with my code. It's just hopelessly slow. Like, so here I was doing, I think, I don't know, 10 million simulations before you see the price gets close, okay, to even the third digit. As you see, like, right, on my computer, it doesn't run that slow. But again, right, 10 million simulations is even for my standard, I'm pretty relaxed in terms of, right, simulation is unacceptable. So again, for this class, right, and especially we're not waiting too long to get the result, I don't care too much. But obviously, right, this doesn't look very professional. So some kind of, right, more advanced Monte Carlo method is called for to reduce this number of simulations and still achieve, right, the precision level. And again, right, this is not the class to discuss that, but I just want to point that out. All right. Any question before we go back to the math? All right. So let's tackle things in the order. First, let's deal with the probabilistic aspect, okay? So of Brownian motion. So something like this, I hope, is very basic, that if we have, let's say this, right? If you have x to be normal mu sigma square, then expectation of e to the tx, okay? And this is called the moment generating function of a normal, will be e to t mu plus 1/2 t square sigma square, okay? So this is called moment generating function. And you see why this is very relevant for us, because this structure right here, right, is a structure of the stock price in the Brownian motion. So that's why we like this result, and we just use it, okay, without needing to reprove it again and again. By the way, I want to mention, right, because the stock price is like this, right? So ST, basically in terms of distribution, you can think of it as S0 e to the normal, e to the normal, okay, with mean mu minus 1/2 sigma squared times t and variance sigma squared times t. Is that okay? That's the, in terms of distribution, that's what it has. So when you take the log, okay, when you take the log, then it's going to be log, right, S0 plus this normal, right? So that doesn't change the distribution, right? You just bring the log inside and it changes the mean. So basically, right, one thing you hear over and over again is that the Black-Scholes model, okay, has log normal distribution. Or the stock price has log normal distribution. Maybe they don't even mention the word Black-Scholes, but when they say the stock price, right, has log normal distribution, you immediately know that they refer to something like a Black-Scholes model, okay? And log normal distribution is a distribution that is used out there, not just within the math finance context. Just, so you know the name, right? Log normal sounds a little bit funny, like the log of a normal or something. That's not the case. It means the log itself is normal. So log is normal, okay? Because taking log of normal actually doesn't work. It can be negative. You cannot take log of a negative number, right? The log is normal, and that explains the name, okay? So log normal distribution. Anyway, so right, from this formula, from this expectation, we can derive everything, right? For example, expectation of e to the sigma wt will be e to the 1/2 sigma square t square, sigma square t. All right. Is this clear from this formula? I hope the application is immediate. Again, right? Formula like this, feel free to quote them, right? No need to reinvent them. You need to be aware of them, and you need to use them. No need to reinvent the formulas. Any question on how these formulas fit together, right? Some identity like this you should memorize and use very quickly in this class, because that allows you to make calculation very quickly with Brown motion. Is it okay? So that means, right, that expectation of, right, ST is what? Well, so expectation of ST is expectation of S0 e to the mu minus 1/2 sigma square times T plus sigma WT, right? So notice some mental math here. It's very easy, right? The plus here means multiply in terms of expectation. Sorry, in terms of exponential, right? But because all these parts are deterministic, it can go out. So all you do is hit the expectation on the exponential of the Brown motion, which you know is this. And because of the product, you see the answer will be S0 e to mu t. Is it okay? Right. So again, right, very quick calculation that I hope. Yes, Don.
That makes sense.
Yeah. Okay. So also again, right, calculation. I'm old school. I do believe that students must be able to do calculation quickly, whether it means anything or not, right? I mean, just do calculation. You must be able to do the formula very quickly. But on the other hand, the more mature part of me also says that you should try to see if there's rhyme or reason in your calculation. It just is good for you, okay? And it helps you do calculation too. Here, right, for me, this formula means a lot as well. Again, what is ST? ST is the stock price. Expectation, of course, takes the average. So on average, you're saying that your stock price is the initial stock times the exponential of the return rate. What's more natural than that, right? Because basically, this, again, remember, this is the saving model, right, with the rate of return, mu. So what you're saying is, right, on average, your stock price behave like a fancy saving account with rate of return mu. Again, right, super natural for me. But of course, right, that means that you average out all the, shock and noise. No, not even that. You average out all possible events, right, that happen in life, which of course, right, doesn't happen in real life. Stock price happens once and for all. But in theory, at least we can say that's how it behaves, okay, on average. You can draw a path, and the stock price supposed to fluctuate around that. What else? This, drives us to this kind of calculation, right? E to minus RT, right? The discounted return, the discounted stock price. Well, you see, right? Then there's nothing but this, right? And I believe that's what your review session was last time. But you see, right? Immediately, then you see if mu is not equal to R, and typically, right, mu is bigger than R. Okay. The return of a stock must be higher than the interest rate. Otherwise, right, the point of view is, stock, right, is referred to as risky instruments, right? Risky instruments versus, like something like a saving account as the risk-free instrument in some way, because, right, you deposit into the money market, you're guaranteed money. There's no risk. Risk, right? By the way, right, risk in finance does not mean something bad necessarily. Okay, say you win the lottery, you win, you invest in recently, right? GameStop. You invest in GameStop and you got like a lot of money because it increased in price for 300%. That's still exposing yourself to risk. You just get lucky. Okay. So risk is randomness. All right. So in finance, no risk means no randomness. All right. So by buying stock, you automatically expose yourself to risk. Okay. And so by that, right, the return rate must be higher than R to compensate, right, for the investor taking on risk. So if the return of a stock is lower than the risk-free rate, no one would even buy that stock to begin with, and that shouldn't exist in the market anyway. Okay. But the point being is, right, so in general, then this will be different from S0, not to even mention that it's bigger than S0, right? So from the point of view of pricing, right, this is not the risk neutral pricing, because risk neutral pricing says this is equal. Okay. So in other words, right, that separates it out from a risk neutral framework, where under the risk neutral framework, everything is the same, except that the rate of return now is a risk-free rate, right? So you see that what that magical change from mu to R means. It basically says that, well, the stock is driven under a different Brownian motion source, right? But the effect of that is now the rate of return is a risk-free rate, okay? So of course, right, I think Professor Larson should have discussed to you that risk-neutral world is, not the real world we're living in. It's just a point of view you use for pricing, derivatives. So, but that, right, you have done the auto calculation, then it's clear that the calculation like this will give you S0, okay, automatically from what we've done above. So there, right? So that at least for one thing justifies, right, that this is a risk neutral model. Well, the move from here to here, right, the move from the physical to risk neutral model is something we'll discuss when we go to pricing. Okay, but that's expectation. Well, what else can you do with this, right? You can do things that may or may not be related to Brownian motion per se, but still good for practice. For example, expectation of WT square. Well, that's nothing but T, right? Why? Because W expectation of something square, right, from probability is a variance plus expectation of the square, expectation square. Okay. Now, WT is an object with variance T and expectation 0. And that's why, right, expectation of WT squared is T. Okay. Other variations that may come up, if we have time, we'll discuss that. But so one thing I want to say, right, is the idea of conditional expectation, which will be important for us. And I think you should have seen that, right, with Professor Larson, right? You should have definitely have done conditional expectation. That's the case, right? This is not new. If it's new, then I'll spend more time, but if not, I can speed up a little bit. You have done this before, conditional expectation?
Yes, we did conditional expectation.
All right, thanks, Sherry. So, so what is it, right? That so here, right, the conditional expectation will be with respect to the filtration in general. Okay, so let me say this. So basically, if you have so for S less than T, right, conditional expectation of, let's say, a future function of WT conditioned on the filtration of WS. Okay. So let me say this nevertheless. First of all, it will be another function, okay, of the W path from 0 to S. Okay, so this is just an abstract notation. This means the whole path of W from 0 to S. Why? Because you condition on the whole history up to time S. Okay, so this is the whole path from 0 to S. And so this says that whatever conditional expectation you're doing, basically you take the whole information that you have available to map it with some function, and then you get this conditional expectation. So in other words, right, it's just really a mapping from the history to a desirable value that you call conditional expectation. But of course, this guy has many properties. So one of the properties is that, right, is going to be a function of the path, whatever you're conditioning on. But a stronger property is this, that it's going to be the best approximation, okay? It's going to be the best approximation. We probably won't use this so much, but I just want to mention it anyway. Best mean square approximation. To whatever you're taking expectation on, based on this. So if you want, conditional expectation is a very, very practical object that you might have seen elsewhere. Basically, it's a projection. You have some object like right here that you do not have access to. You have access to something else. You want to say, okay, based on this, what is my best guess, best estimate on this? In some sense, the sense is the mean square sense. Then you say, well, of course, then conditional expectation gives you a rule, a way to do that guess, a way to do that projection. Of course, right, we're not spelling out the rule right now exactly, but you know, we kind of defining it. Anyway, right, the best is this, that I just want to write this down. So if you take the mean square error of another guess, okay, like this. So this is the mean square error. Right. If so, phi tilde means some other guess based on the path. That other guess will always be higher or no less than the mean square error you accrue by the conditional expectation guess. Is that okay? So that's why it's the best mean square approximation. If you take any other guess, you will accrue some error. That error on average will be higher than the error you make with conditional expectation. Okay. Fancy language maybe, but it's really very simple in idea. And if you want, let me tell you something like this that's really easy to understand. Let's suppose you roll a die, okay? A die means 1 to 6 with probably 1/6 each. Let's suppose that someone says, you know, you guess a number, okay? You tell me you guess a number. Guess the value, right? And your guess doesn't have to be integer either. It can be anything, right? It can be a fraction, it can be a a real number. But the point is that you pay a cost for your error, okay? Like you guess a number, right? And the die roll out, and you pay the money, okay? You pay the square of the money for whatever error you incur from the actual outcome, okay? You pay, for the square of the error. Does that make sense? The game, I mean, it's a silly game, right? But what guess should you make to minimize your payment? Okay, does it make sense? The answer is to minimize your average error. Suppose that this is a very cruel person who makes you play this game over and over again, even though you don't like it. He just forces you to play it. Then the guess you should make is the average of this, which is namely the expectation, which I believe is 3.5, if I'm not mistaken. It's been a while since I did this math, so I think it's 3.5. Don't trust me on this, but it's true that you should guess the expectation. Okay, so the expectation, right? Because here, when you say guess the value, it's some kind of conditional expectation too, but conditioning on nothing, condition on no information. So in that sense, right, when you condition on no information, that's just an expectation. But the mean square error property still holds. In other words, for any other value you can guess, this is the value that minimizes the error, right? The mean square error away from the actual value. So in that sense, if you guess this, you will pay the least on average. Okay, so that's the meaning of this. Any question? All right. So for our purpose, right, something like this is what we're interested in. Suppose you need to compute it. Expectation of WT, condition of FWS for S less than T. Okay. So how would you do so? So here, when we ask this kind of question, you can be pretty sure that more or less we want some kind of explicit answer out of it. All right, not some abstract discussion. Because here I do the abstract discussion because I don't have an exact form of F. I don't, but so I just give you the meaning. But here, when I say something like this, we want to do the exact calculation, which still, right, whatever the answer I have, still preserves the meaning that I was discussing about best mean square error. So the technique here that you want to do is the so-called utilizing the independent increment. Utilize the independent increment, okay? Property of Brownian motions. What do I mean by this? Well, you introduce the increment however you see it. And of course, the easiest way to introduce an increment is something maybe surprising like this. Okay. Now, what did I just do? I did something that looks bizarre if someone's not used to mathematics. I just write something, by adding and subtracting a different term. Okay. But doing this actually is not just, bizarre stuff. It actually decomposes, right, WT into two components. One is the past price, which I know by time S. One is a future increment, which is independent of the past history, as I discussed, right? That's the property of Brownian motion. So very important for our calculation that the future increment is independent of the past history. WS, I hope Professor Larson used this notation too. What it means is it's known by the history, right? It's known by observing the past. I mean, the notation even suggests itself. This is a whole history up to time S. Definitely WS is observed, right? Is it okay? So in other words, right, what you can do here is you can bring out, right, the E to WS because it's a constant as far as this conditional expectation is concerned. Is that okay? And then the whole point of independence, right, is that independence means you have no information. Conditional expectation means you try to make the best guess based on the information you have available. But independence means it's like whatever you know has no relevance to the question you're discussing, right? It's like, I mean, you roll a die and you make a guess based on, the weather in Pennsylvania. I guess there's no relation between the weather in Pennsylvania and the roll of the die. right? You could, but it basically comes out to the same thing. So here, right, is e to ws, expectation of, so this is by independence, right? So this is by the fact that e to ws is known, and this is by independence. Is this okay? And once you drop it, right, then it just becomes a good old expectation, where recall that this guy has a normal distribution, right? This is a normal zero t minus s. Therefore, this is e to the 1/2 t minus s by you know, the moment gen function property. Any question here? Is this calculation okay? All the rules I quoted are seen before, not something new. Any steps here that you want me to explain again? You will be asked to do this kind of things, okay, on your homework and your exam. So ask questions. I take that as a no problem. Okay, so let's take let's apply this kind of calculation to the stock price, right? So before, right? So again, recall that stock price is S0 e to the R mu, right? Let's take the physical model. Okay. So before we take expectation, right? Now let's take conditional expectation. So let's say for t less than u, right? Let's consider SU condition on information up to time t. Okay. So notice, right, I always keep W here as signifying that the information here is information generated by Brownian motion. But again, I hope Professor Lawson discussed this, because S is a function of the Brownian motion. Knowing the Brownian motion is exactly as knowing S. So condition on this or condition on the stock price is actually one and the same thing. But you know, like it looks a little bit unprofessional to condition on something a little bit more beyond what you need. So right, you always kind of condition a source of noise, keeping in mind that, right, anything else that depends directly on the noise is deducible out of it. Okay. So what are we doing here? Here it has some kind of meaning, right? This again is your past history, right? All the history up to time t. You are trying to make the best guess of the stock price at some future moment based on, right, the information available up to this time. Well, again, you see, if you break down the whole calculation, you get this S0 okay. Oh, sorry, right, it's U. And then pay attention, right? There's a lot of constants here. Everything here is constant, right? Everything here is deterministic. So it really comes out. So at least with the Black-Scholes model, a lot of times things are very easy. You're just really playing with the source of noise, which is this, right? A lot of those other things are decoration, right? They're there to add to the rate of change, to the rate of return, but they don't do anything in terms of randomness. So anyway, right, when you factor it out, like this, right, you have this left. And you recognize, right, this exactly is the calculation we have just been doing. But, you know, I guess with a change of labels, right, U and T with a sigma in front. Okay. But then I hope that it's not surprising that the answer will be this, And then this is e to the sigma wu, and then e to the sigma square 1/2 sigma square t minus u. Is that okay? Sorry, u minus t, not t minus u. Sorry, give me one moment here. I'm a little bit. So, okay. So these combined together, right? These combined together gives you SU, right? These combined together give you SU, and then this gives you e to the 1/2 sigma square u minus t. Okay, like that. I just feel like my calculation is wrong. I can't see where I make a mistake, but I felt like I make a mistake somewhere.
I feel like it kind of makes sense in a way.
Yeah. Okay. Let's try. So everything seems okay, because I mean the real test is when I applied it to the risk neutral case, then it should be a martingale. All right. So I think it's okay. All right. Let's carry out. If I detect.
Calculations, yeah.
Okay. All right. Cool. Then if you spot anything obviously wrong, please let me know. I think this is fine. Okay. So right. So this is just. So again, right. This is basically calculating, right, the future stock price based on the current information. All right. So now, yeah. Okay. So now let's apply that to the risk neutral case. So in the risk neutral case, what I have is ST equals to S0 e to the R minus 1/2, right, sigma square T, right, plus sigma W tilde T, okay? So if I can compute conditional expectation of, right, ST given FWU, all right, what do I have? So something is weird. I really felt, because, sorry, hold on. It should really be, this is SU and T. Okay, so it should be that for T less than U, if the result I want is something like this, and I know it's true, that expectation of e to minus R U minus T like this is equal to ST. Okay. So in other words, what I should get is expectation of SU given this is e to R U minus T times ST. Instead, what I get is something like sigma square, which you know, if I trust the above result, which doesn't seem to me to be making sense. So I'm just wondering if, oh, sorry, 1 second. 1 second. I think I spot what my error was. Sorry, give me a moment. The reason is when I do this, I want to cast everything back to ST. I do not want to cast this into SU because U is in the future. Okay, U is in the future. What I want to do is rewrite everything in terms of ST and not SU. So that probably is my error. Let's see how I can do this.
So if that's the case, how do we interpret SU in terms of SG?
You know, hold on. Actually, what the heck did I do? I'm sorry. My brain's not working. Yeah, Giovanni, you want to say something? The error is here. It's not supposed to be WU. It's supposed to be WT, right? Because T is the time before U. Is that what you want to say?
Yeah.
So I quote the wrong time. All right, sorry guys, but because somehow I'm so used to thinking that T is the time after. But remember, right? The whole point of conditional expectation is really intuitive, that it's a flow of time, right? You can condition the future on the past, right? You've conditioned the future onto the past, right? So whatever that the result comes out, it cannot depend on future information. Maybe that's a good lesson. I did not intentionally make this mistake, but whatever the result is, right? It cannot, right? The result cannot depend on the future. Is that okay? So that's a rule of thumb. The result cannot depend on the future because you are conditioning the future on the past, right? You want to make the guess on the future based on the past. So what if you write down anything involving the future, you're writing nonsense. So I did not intentionally write something nonsense. It's just I was confused between the U notation and T notation. So here, right, it should be WT instead of WU. Is that okay? It should be WT instead of WU. So in fact, right, what happens is it comes out very, very nicely because you see this cancel with this, right? And then this go with this. So hold on. But then that, so, okay. So I'll do this, right? So there's some, so this cancel with this, right? Then you got e to 1/2 sigma square minus t, right? And then sigma WT, but you still have mu u here. So what you need to do is this. You need to do S0, okay? E to the mu t, right? And then you have mu u, right? So you got, and then you got e to minus 1/2 sigma square t, and you got e to sigma WT, and you got e to the mu u minus t. Is that okay? So there's a better way to do this. All right, I will redo this. This is not a very intuitive way to do this. This is mathematical. But again, right? So my mistake was writing WT here, right, instead of WU here, instead of WT. So then sigma square u here cancel with sigma square u here, right? This is the minus term here. So I have mu u, so I need to do mu u, right? But I want to recover the ST, so like this. And so the final answer is really, right, ST, right, e to the mu u minus t. Now this makes better sense. This makes much better sense. The reason is this, right? Again, what am I doing? What I'm doing is I look at the future stock price based on the current information. What it should tell me is that, well, it's going to be the current stock price times the rate of return, right? Times exactly the movement of return that I get during that time interval. This is nothing but the analog of the other calculation we did. right here, right? The future stock price is the current stock price times the movement of the return. So when you do conditional expectation, what it tells you is you get exactly the same thing. In other words, you get, right, future stock price condition on current now being T will give you this, okay? So actually that was really a messy way to do calculation. Sorry, let me do it again. This is not good, okay? Let's do an easier calculation. It's fine, but it's not good. Sorry. So redo the calculation like this. Again, my goal is to calculate expectation of SU given the current information. What I should do is always, right, the theme is to decompose the future into past, into present. Plus future increment. By plus here, it doesn't have to be really plus. It could be plus in the including, and, okay? So for example, right, WU in the future is WT plus, WU minus WT for T less than U. That's the decomposition. Here, I'm dealing with a stock price, okay? So I could look into the increment like this, I decompose a W like this because W goes into makeup of S. But that actually is not very intuitive. What I should do is decompose S itself. That's why I was confused. I should decompose S itself. How do I decompose it? Well, S, right, SU is ST times e to the mu minus 1/2 sigma square U minus T plus sigma WT minus WU. Does that make sense? So this is the present. This is the future increment, right? So what I'm claiming is for any T less than U, S future is S present times, the return, the log return rate, U minus T plus sigma times the Brownian motion increment. Sorry, keep writing the wrong order, WU minus WT. Okay. So I claim that this is a more natural decomposition for the stock. Again, nothing wrong with, doing what I did before. It's just awkward because at some point I was confused between what's present and what's future. And when I put the pieces together, I just make a mistake, right? When I decompose on the stock itself directly, I'm less likely to make a mistake, as I show you why. First of all, right, that ST here, right, is known by time t. So I will bring it out. And then this whole thing actually will also be brought out. What I have left with is this exponential on the Brownian motion. But this is future increment of Brownian motion, so it's independent of the present, right? So this is independent of the present information. So this will just breaks down to pure expectation, which will be equal to e to 1/2 sigma square u minus t. But then you see, right, it cancels perfectly with this giving me the final answer to be ST e to mu u minus t as desired. Is that okay? So the point is, right, decomposing the future stock price with the current stock price times the movement is a more natural way to do it than just decomposing the Brownian motion itself and then fiddle around with the stock. Any question on this? Is that okay? So sorry for the confusion, but okay, thanks. All right, so now, right, so I hope then when we deal with, right, risk neutral version, then everything is straightforward, because risk neutral version basically, right, distribution wise, everything is the same, except that you replace mu with r, right? Brownian motion is Brownian motion. So when you take expectation, you should expect that, you should know that everything else is the same, except that mu is replaced with r, like that. Everything is the same. But of course, right, because everything is the same, then when I discount it, I get ST. And so this glorious result right here, right, is telling you that the discounted stock price is a FW, right, martingale, like that, under the risk neutral measure. Okay, and I think you have seen this result many times in Professor Larsen's class, right? But basically, you have a model and you do some transformation until you get to this glorious, pricing formula, or rather pricing relation, that when you do discounted futures price, you get the current price, right, based on the past information. And when you achieve that, you have got a martingale and you got the pricing structure working for you. And so that is that, right? So that's the point I want to highlight. Any question? Okay, so I would say all the calculations that you can consider, I won't work it out, but you can consider, for example, suppose S is less than T, what is expectation of WT square condition on WS? You can put the whole past history here. It doesn't really matter, as we mentioned. Basically, you see that all the calculations we did, right? When we condition on the whole past history, eventually it only turns out to be dependent on the WT itself via the ST, right? ST depends on WT. So when you condition on the whole history, but your result only turns out to be dependent on the most recent past, that's called the Markov property, okay? That's called a Markov property. So we mentioned that in more details later on. For now, this version is fine. But when I ask this calculation, you can think of it, if you want, as conditioning on the whole past history or conditioning only on the most recent past. That's the same thing. The point is, how do you do this calculation technique, right? How do you break down the past and the present, the present and the future increment, right? So that you can do the calculation. In other words, you do something like this. And then you carry it out, okay? So I'll assign that as a homework and as, a review session for you to practice. But again, I mean, this calculation may not have any real application for what we're doing in terms of pricing, but it kind of asks you to practice on this idea of, breaking down, right, the present and the future, and work with, Brownian motion in terms of its probabilistic aspect. So they are good exercises. to do. All right. Most of the calculations we will be doing center around something like this kind of flavor. Okay, with exponentials because we deal with price. All right. So for the last 10 minutes or so, wait, hold on. The class is 10:40, right? So I have half an hour. So for the last half hour or so, let's go to the point 2, which is the stochastic calculus. Okay. And so stochastic calculus basically has 2 portions. One is the so-called integration, and that falls under the name of Ito integral. And the other part is differentiation. And now let me put them in quote because they're not necessarily what you understand as integration and differentiation in classical calculus. That falls under the name of Ito formula. Okay. So you will have to be able, you have to remember and memorize Ito formula and apply it, because that will be, you know, the basis for us to do some other work later on. But the Ito integral, I'm just going to mention in passing, and you should be aware of some properties and why we care about these things. It works in a strange way, but we won't go deep into the math of the Ito integral. So what happens is this, right? The key idea is how to work with the differential of Brownian motion. Okay, how to work with dWt. So to give you an idea, right? To give you an idea, for example, the Black-Scholes model is this. Right. I want to recover ST out of this. Yes. So here, the Black-Scholes model, what it does is it gives me the differential in the stock price. It tells me how the stock price moves. It tells me how the stock price moves. So, right, the basic calculus, or just basic idea in life, is like I said, if you do the big differential, that's going to be, right, the addition of all the small differentials. All right. Now let's forget on how to do this explicitly, but let's just see what it implies. It implies that you have to add all these guys together, and then you have to add all these guys together. Okay. So you know how to add these guys together. This is just the Riemann integration. How would you add these guys together? Well, you say, well, that's easy. Didn't you just show us, you know, something like that in the Monte Carlo simulation, right? That's exactly the stock price path number 2, I think, right? When I add like delta dWi, add with SI, that kind of thing. So that's where, you know, some kind of magic happens, where I was doing a simulation, so I didn't care for the error and the math behind the scene. But in practice, okay, this object is pretty bad. This object is pretty bad. In what sense is it pretty bad? It's pretty bad, or it's pretty complicated to deal with, exactly because Wt itself is nowhere differentiable. Okay, because Wt is nowhere differentiable. Remember, the path of the W is very rough. When you look at its differentials, okay, its differential is not well behaved. Well, in which way? We'll explain. But for example, the du here, when you think about it, the time differential, right? Every time it just goes up. Time just goes up. So every time you just keep multiplying with a positive piece, isn't it? You keep multiplying with a positive piece, and you keep adding things up. Here, the dwu, right? Sometimes it's positive, sometimes it's negative, sometimes it's big, sometimes it's small. Okay, and you add all of these together. Now, it may not be a super concern for you, but when you really carefully look at things, you're adding up, right? The whole point of integral like this is adding up a bunch of small pieces. And this number of pieces is a lot. It goes to infinity. You keep adding a bunch of infinitely amount of small pieces like this together. And if these pieces are ill-behaved, okay, if these pieces are ill-behaved, in general, your integral will not converge. In other words, when you push the delta t go to 0, you will not get any meaningful conversions out of this. Okay, so that's the story in the kind of a very quick 5 minutes explanation of why something like an Ito integral needs to be defined, because you cannot define these conversions in the regular way as you define a Riemann integral. Okay, you cannot define like that. You must have a special way to define this integral. And so I'll just write it down, all right, and we will not really mention it too much. But the integral, okay, let's say this, f of something, which is approximately the sum of the partial term like this, okay? Does not converge pathwise, but converge in the mean square sense. Okay. What do I mean by this? What I mean by this is if you take a path of a Brown motion, you really take a path and you decompose it, right, into small pieces, like so. Here's a path. Here's 0, okay, and here's t, and you decompose it right into small pieces like this. And at each point, you take the value of whatever you want to integrate, you multiply with the Brownian differentials, and you keep dividing that, right, to smaller and smaller, right? Each time you do it, you get a number, right? But just the sequence of the numbers will be very ill-behaved. It will not converge to any value at all. And that's what we mean by do not converge pathwise. So for any path of the Brown motion you can draw, you pursue this object as n goes to infinity, you will not get any conversions in terms of mathematical sequence. On the other hand, if you say, okay, I do not care that for each path it converges, but I want to say that on average, right? Because remember, this is a random object. So for one path it doesn't work, but another path, right? Because I just do a million paths, right? On average, if you compare the partial sum like this, okay, on average, it converges to an object, okay? It converges to a random object. That object is referred to as the Ito integral, namely this, okay? Now, again, I realize that I just quote a bunch of real analysis like language, which you may or may not have heard of. So do not worry about this, okay? Well, all I want to mention is that, yes, right, when you work with Ito integral, when you work with integrating with Brownian motion, just be aware that someone may mention that, like this is not real convergence or something, or this is not convergence pathwise, and you have some idea of what they mean, okay? Another way you can see this is this, that I'm not sure you ever play around with this, but have you ever tried something like this, right? Suppose you have a function g of t, okay? You try to play around with calculating a to b f of t dgt. So admittedly, right, this is just a mathematical expression. But suppose that someone write down this expression and they ask you, do you have any idea what this means? And you have access to the computer, right? You just try to do something with it. You're not asked to define it mathematically. They just ask you to calculate out as numbers. For example, right, let me give you something to easily imagine. Like this, right? Do you have any idea of how you would go about doing this? Approximately. And let's say a equals to 1, a equals to 0, b equals to 1.
We're going to need to first calculate ft times dgt first, and then for the integral.
So I suppose you're saying something like this, right? You will take 0 to 1, you will divide it into like so many subintervals, right? Let's say
yes,
subintervals, right?
Yeah.
And what you do is you will do the sum, right, of f of ti, g of ti plus 1 minus g of ti. Right? And then you would push the n to infinity and see if it converges to any number. Is that right? So yeah, right, that's a valid approach, and that's exactly what usually people do anyway. So the point is this, right? Let's take I don't know, let me switch path. All right, let me do this actually. Let me do this. Okay, suppose that's the case, then do you know what the integral of this supposed to be? Well, of course, you can carry out the procedure mathematically, right? But it will come out to be dgt, right, will be, because gt is t squared, right? Gt is t squared. It will come out to be 2t dt. It will come out to be 2t dt. So it turns out to be, 2 integrals 0 to 0 to 1, t e to t dt, which you can carry out by integration by parts. Okay, so what I'm trying to say is you can calculate this out explicitly and you get a numerical value. This is calculus. You can do this numerically, all right? And then what it turns out is this and this will give you the same answer, okay? This and this will give you the same answer. On the other hand, all right, on the other hand, suppose you try, let me see here. This is not a real example, but suppose that instead of doing this, all right, what you will do is you will try g. So when you do dgt, all right, let's just say that you do this to be square root of dt. Okay, another example. So what I'm trying to say is, suppose someone asks you, do you have any idea what this is? Okay, now what would you do? Again, right, you will do something like this, divide the interval 0 to 1 to n subintervals, right? But then, of course, the object that you will do is going to be the sum of f of ti square root of ti plus 1 minus ti. Is that fine? Is that fair? Now, as you push n to infinity, what do you expect to happen here? So let me say again, right? Here, for example, following this procedure, as you push n to infinity, you should get that this and this converge to the same number, right? Or this you calculate, right? calculus. As you push n to infinity, what do you expect to happen here? Let's say, so what do you say, Don?
It should reach to a certain number.
It goes to a number, you say? Some mysterious number?
Yeah.
Good guess. As n goes to infinity, it will converge to infinity. It will blow up.
Oh, okay.
Yeah, it's surprising, right? But what's the difference? Okay, the difference is here, is that the differential here is very big, is very rough. Okay, so this integral, this partial sum will not converge for you. Now, intuitively, right? What's going on? Let me ask you this: which one is bigger? Which one is bigger? Or maybe let me make it easier for you. Wait, this is fine, right? Yeah. Which one's bigger? The square root is bigger, right? The square root of a smaller number is bigger. It's actually the right-hand side 0.1, right? So you see, but the problem is just going to get worse and worse, right? As you push this smaller, the square root will be much bigger than the small number as that small number goes to 0. So what you're doing, you see, the whole point of convergence is that this guy gets smaller, right? Because you got a lot of sums. But if this guy does not get small enough, then your sum will not converge at all. Is that okay? So that's what's going on with this thing. So the differential here is not good, right? And in fact, it's not the dt that you're used to, right? It's a square root here. So in fact, you see here the dgt here is very nice because it's just like 2t dt. So eventually, this is what we call absolutely continuous with respect to dt. So it can be cast back to dt. Anything else cannot be cast back to dt. Is pretty rough. The Brownian motion, waving hand. So like this, the Brownian motion has this property. The differential square of the Brownian motion is dt. Or if you prefer, that's exactly the example we're talking about. Except, of course, that writing this is not precise for many reasons. A, this object is random. B, this is because its Brownian motion can go up and down. It can be plus or minus. But if you understand this to be of the order of, okay, is at that order, then you see that, right, when you add Brownian motion like this, you understand, right, by what I just explained, you're into some troublesome thing, okay? You're into some troublesome behavior. So that's why the integral of the Brownian motion form has a different sense of convergence, but if you push the path, it will blow up. It won't converge, all right? I will show you at the end of the class on the order of the Brownian motion, okay? With our simulation. It's very easy. But maybe I'll ask you to explore this, right, on the review thing. By the way, can everyone run some sort of Python stuff? Okay. Does anyone have trouble like running it in some way?
And it goes up pretty okay.
Okay. Yeah, because again, right, I when I put the review,
though.
I'm sorry, Don. What are you
I
saying?
still need to learn more about how to use it though.
Yeah. That's fine, right? But how to use it is one thing I find from learning code, and I think Sherry can comment on this. She's the expert, right? Is I just copy paste. Of course, it may not be the best code available, but if I understand a piece of code does something, I copy paste, I modify it for my purpose, right? It works. And so some of the code, right? You
can copy from the HTML one and paste on it.
Right. But I'm saying like, from all the questions I ask, right? You copy paste, but of course you need to modify the line of code a little bit, right? To do whatever you do. But right, it should work. Anyway, right, so I asked you to explore this a little bit, okay, to appreciate the Brownian motion creation on Friday. So anyway, right, so that's the point. That's why we need to pay attention to Ito integral. It's not a routine thing where you just push, dt to 0 and you expect a conversion. All right, I'll leave it at that. So now, so what object, right, is an Ito integral? So the following you want to memorize, okay, and you want to remember. The intuition is what I just explained. To explain it further, I think it's not worth it for the class. But there's the following thing. Suppose you have a stochastic process, okay? F of t, that is like this. So I'm not sure if Professor Larson used the word adapted to FWT. Have you heard that term before? What it means, right, is this is like something that can be known by observing the Brownian motion. Or to put it bluntly, is some kind of function of the Brownian motion. I mean, path in some way, right? But abstractly, I just write something like this, meaning it's something that is known by observing the Brownian motion. It's a function of the Brownian motion, but maybe a function of path. Doesn't have to be a function of one thing, right? It's adapted to it, meaning by observing the Brownian motion, I can know what it is. So whatever this is, all right, what I do is integrating with respect to the Brownian motion. Okay, first of all, it is a stochastic process. Okay, it's a process because it's random and it's moving with time. It's also adapted to Brownian motion. In other words, by observing the Brownian motion path, I can know the integrand, but I also know the integral if I can observe the whole history, which makes sense, right? When you add things up, of course, you know what the value should be. So that's just nothing new. But moreover, right, there's a very interesting property that's above and beyond this. Moreover, it is a martingale with respect to FWT. Okay. In other words, for let's say for t less than u, if you take the expectation of the integral up to u and you condition only on current information, what that says is it's going to be equal to the integral up to time t. That's martingale property. Okay, that's martingale property, right? When you take the future expectation based on current information, you only get the value up to that time. Notice what this implies is something like this, that if you take the future movement, sorry, from, I keep doing the wrong thing, sorry, u and t, okay? T is behind you. So if you integrate from t to u, condition ft, you get 0. You get 0, okay? You get 0. This actually has a very deep implication that we may not have time to go into this class. If you try to think about it, right, the stochastic integral is like an investment scheme. Okay, it's like an investment scheme. If we have time, I'll try to explain this more for you next class. Because basically, think of this as how much you buy and sell in terms of the Brownian motion, right? But instead of the Brownian motion, you can think of like stock, whatever. But let's say you bet directly on the Brownian motion. You say, I want to buy 1 share of the Brownian motion at time 1, and then I will hold -1 share at time 2, etc. Right? So this right here tells you how many shares you hold. Of course, right? What do you gain from this investment scheme? The net change of your investment scheme will be how many shares you hold at that time times the movement in price, isn't it? So right, so this is like betting, right? Or if you want, someone say, you have like random walk. You put your money on whether thinking of the movement is left or right, right? I think the Chinese has this, whatever thing that bet on red and black or something, right? Something like that. So you keep betting, right? The point is this, that if the underlying string, oh, did I mention the Brown motion itself is a martingale? Maybe I should, right? If you bet on a martingale, then doesn't matter what scheme you're betting, okay? Doesn't matter what scheme you're betting. Your net gain in the future will be zero. You cannot, as long as your betting scheme is adapted, okay? So it says that you cannot gain by betting against a martingale, all right? So doesn't notice, right? This is remarkable in the sense that I did not say what this investment scheme is. As long as it doesn't cheat, as long as it doesn't look into the future, all right? There's some other conditions like it cannot be unbounded, that kind of thing. Let's not, get into the technical details. But the point is, if you don't cheat, you don't look into the future, you don't know the future behavior, then, right, this equation says on average, you don't expect to gain anything from the martingale, all right? So maybe let me say one thing here, right? WT itself is a martingale with respect to its own information filtration. This one is very easy to prove. Why? Because expectation, right, for t less than u, expectation of WU, condition on this, right? Here you can play the game of decomposing, right, the present into the future and the present. Okay, and then you can bring the WT out. And because the future is independent of the present, it becomes just an expectation. And the expectation, of course, is zero because expectation, Brown motion has zero increment on average. So like that, right? So the future movement of W, right, from the point of view at time t is just a current value of W. So W itself is a martingale. So what we're saying is, right, integrating against a martingale gives you a martingale, which I believe Professor Larson might have mentioned something like that, right, as a discrete version. Okay, some other properties which we will discuss next time. You know what? Let me throw this in, okay, and so that you can do some work, and then we do the differentiation next time. So some other properties, okay. Expectation of Ito integral will be zero. This actually comes from the martingale property. This is very easy. Okay. So because, right, the expected gain is zero, you should not be surprised that the expected gain is conditional expected gain is zero, so expected gain is zero too. So that's one property. Second is about the square of the expectation. So namely the variance. Okay, the variance. If you square this, then it will be like you square the integrand and integrate with respect to ds. Okay. Finally, if the integrand is deterministic, in other words, it does not depend on WT. Then you know more. Then this guy right here is a normal random variable with mean zero and variance this. Okay. So pay attention between this point and this point. This is true for any integrand. This is only true if the integrand is deterministic. For example, right, the integral of WS against itself is not normal, but the integral of S dWS is normal because S, right, being a time variable, is deterministic, meaning it's not random, right? So when we say deterministic, mostly just things that depend on time, and then, generic parameters. Okay, so I realize time's up. Let me show you one thing about the code, okay, about the differentials, and then we'll be done. So I want to show you this, that basically, right, notice we say the stock price path is similar to ground motion path. One of the reasons is because the DWT is very big compared to DT. And that's why the behavior, the ground motion dominates. Okay, so what we can do is we can just print, let's say, DT, all right? That's how big DT is. And let's show you DW at, like, I don't know, 10. Okay, that's the value of the DW, right, at the 10 step. Any step we want. Let's see what it is. So, oops. I mean this. Okay. So you see DW, DT is 0.001. But you see DW is 0.05. Okay, let's run again. 0.001, 0.01. Is that okay? So the DT is getting smaller, right? But DW, of course, is getting smaller too, but it's smaller on a very different order, square root of that. And that's why, when you sum, right, when you sum all this DW, even if you push the DT go to 0, the DW still remains large. Okay, and that's exactly what we mean by say DWT is square root of DT, and that causes the behavior, the rough behavior of the ground motion. Okay, so I think I'll stop here. Some students want to ask me questions on coding, so I'll remain and answer questions on that. If you have questions on coding or all the stuff, you can ask me as well. If not, then have a good time. I'll see you, next class or in office hours. All right. Any questions you have? Go ahead.
Hello, Professor. In the second problem of homework 1, the part C,
Yes.
When I'm coding, when I write the code, how can I write the DT and the DWT?
Wait, hold on. Homework is not supposed to involve so much coding right now. You mean this part? Compare the log returns versus percentage returns?
Yes.
Hold on. Am I sharing that for you? Yeah, you're seeing my screen, right? So, so what I mean is this, right? What you want to do is you just take this value, right? How do you define log return or percentage return? Percentage return, say from 0 to 1, will be this divided by S1 minus S0 divided by S0, right? Times delta T.
Yes.
Percentage return from here to here will be this minus this divided by S1. And then you get the sequence of 4 numbers, and you compare that with the single number, mu. And you do the same thing, and you compare that with a single number, this. Or you want me to write it down for you?
Wait, I just need to use the formula you gave us directly, and
yeah, it is really just calculating out these values, S1 minus S0 over S0, S2 minus S1 over S1, for percentage return, right? For log return is log of S1 over S0, log of S2 over S1, right? So basically you get a sequence of random numbers, right? But those supposed to represent the log returns and the percentage returns. So it just gives you an idea of how the log returns behave. And for example, right, I can see, for example, here you got 22.89% return, right, for the first year, right? Does that make sense?
I see. Okay, I see. And the problem 3. The problem 3, the part A, how can I graph the VT and the ST?
I'm pretty sure you can draw the graph. And it should be like a piecewise graph or something.
Correct, exactly. It's a piecewise function. So hold on.
Mhm.
It's right. It's something like so. By the way, right? Graphing payoff function is a very routine. Graphing payoff function is a very routine thing. Let me see here. Sorry. Okay.
But
So, for example,
just draw.
I mean, you realize that, for example, the call option, right, has this kind of graph. Yes, this is call, right? Because it's st minus k plus. So as a function of st. So in the butterfly, is a three pieces function, but I believe that you get something like this if you chase the definition, right? Something like that.
So I can ask a question about 3.
Yeah, sure, Dom.
Okay, so this is just about C, where you have to like find the replicating portfolio. Is this just like basically finding VT in terms of like calls or puts? And is it okay to use both of them?
I think it definitely, you don't have to. I think if I recall correctly, you can use pure call, pure put, but you can use both. I think. I'm not sure showing call is like put or something, but I think the author of the answer is just short call, short pure call, short pure put. You don't have to use both, but it's okay if your answer is correct, you can use both. Yeah.
All right, I just wanted to be sure.
Yeah. Because actually, Don, I don't think so. I mean, here's this. If you have to use call and put, I think you have to throw stock into the mix. But I think the question doesn't ask you to use stock. So
yeah, they do.
You know, because if you use call and put, I think because of put call parity, you have to throw some stock in. Technically speaking, it's not that wrong because we just care for, you know, replication. But because the question only asks you to use only call and put. So if you throw in stock in the mix, you kind of violate the problem a little bit, right? But in terms of replication, I'm not saying that you're doing anything wrong. Does that make sense?
Okay. Yeah. All right, just wanted to be sure. Thank you.
Sure. Any other question?
Yes, and in problem 2, the part A and part B are just using the formula you have gave us to calculate.
A and B. Yes. So again, right?
Oh.
So for A, you do
Use
something.
the S1 minus S0 divide S0.
Yes.
Oh.
Okay.
I thought it I thought it in the wrong way and confused that why it was severely difficult.
Oh, okay. Yeah, no, it's not supposed to be difficult. It's just supposed to.
My comprehension, my comprehension has some problems, and in problem 3, the part B, the problem 3.
Yeah. What about problem?
The part B means that just use the routine routine way the butterfly stock goes to answer it.
So let's see. So basically, right, you see here's the butterfly, right? Here's the payoff function.
Oh.
And supposedly in part B, you start out in the middle, right? This is where you are. Now, anyone who wants to invest would want to not lose money, right? Meaning they would want to have positive payoff. In other words, they want the stock in the near future to only move within this range. Okay? But if they want the stock to move within this range, what it means is it's not very volatile because that range is small, right? You do not want the stock to go out there because if it goes out there, you get paid nothing. So a butterfly investor is betting on low volatility in the near future?
Oh, the butterfly means that the tendency the stock price goes won't make the buyer to lose money.
No. Is something you can choose to buy or not, right? No one forced you to buy butterfly, right? As an investor, okay?
And
So
the tendency could help the buyers to earn money.
correct, or you should put it the other way, that the buyer is expecting or is hoping that this will happen, right? I mean, so he or she buys this, he or she expects that the near future, right, will not have high volatility.
And the replicating portfolio just use the simple way to draw it.
What do you mean by simple way?
Use the replicating equation.
Could be. It may not be that simple. I don't know. I mean, you can look up on Wikipedia, for example. But basically, the whole point is you need to replicate using calls and puts. So the answer is something like I think V call K1 minus 2 V call K2 plus V call K3, something like this, if I remember correctly. That's the replicating portfolio for butterfly.
Okay. And the D and E parts should use Python.
D?
D
and E, you said?
Part D and part E, we should use Python to draw it.
Wait. D is the calculating the probability. So you should use the math to do it.
Yes, use Python.
Oh, Python. Oh no, you don't have to. No, you can just do hand calculation, right? There's no Python here that you need. No, you don't need to. You can play around with Python, but Python will not give you exact answer. I want exact answer. So yeah,
okay.
You can play around with Python, but no need. Just calculate out directly using math.
Okay. Let me. And I will mute now. I want to calculate by myself.
Okay. Yeah.
Professor?
Yeah.
Hi. I have a quick question about the butterfly spread.
Yeah.
I noticed that there is no aspect of time, or at least when I was trying to understand it when Googling, like because when we calculated the replicating portfolios before in the binomial model, like we had T, so we could kind of like backtrack in time.
Yeah.
I was wondering what role time plays in this. Can we just like
so Cherry right here, right? When I say this,
yeah,
I mean, they all have the same maturity with the butterfly.
okay. And for this, is this continuous? Is that why we don't index the
So okay, also replicating, right, is you are thinking of different replicating, which I know exactly what you're talking about. Now, replicating, right, is a very abstract word, a vague word, right? When you say replicate, right, English replicate means copy, right?
Yeah.
So when you say replicate, whatever that is, that copies. So when you do it with Professor Larson, I think what you're doing is you replicate a call option with stock and cash.
Yes.
You try to remember it.
Yeah.
And also the point is this: from the stock and cash, then you try to pull it back to time 0, and then you try to project it back to time t.
Exactly.
But that actually is that actually is deeply connected with pricing, because when you replicate with stock and cash naturally can be pulled back to time zero because of the discount, etc. And so when you project it up to time t or whatever, you indirectly price the call option. Okay, so that's why I was telling Dawn that stock is not supposed to be in here, even though she used it, it's fine. The reason is actually the spirit of this problem is not that directly, meaning I'm not asking you to replicate butterfly with stock and cash. Right? Okay. I'm not asking you that. I'm asking you to replicate butterfly with calls and or puts, but it turns out you only need calls.
Oh, okay, I see.
So you're replicating a derivative with another derivative, right? So in that sense, what are you doing? You're decomposing a more complex object product into the product that you have known before, which is the call. Now, if you are so willing, you can replicate a call with stock and cash if you want, but that's not right. The understanding here is if you have access to the call price, you can use the call, and the technical term is synthesize, right? The butterfly.
I see. So instead, we're actually trying to like come up with a formula rather than having like quantities of the stock and cash. So
no, and again, right? I'm not building a portfolio here. Does that make sense?
Okay. Yeah.
I do, but the aspect is really different. You understand what I mean? There's no time dimension, like you said, exactly, because I'm not trying to price this butterfly call. I will, right? I will ask you to price it maybe this week. But how do you price it? If you can relate it to the calls, then by pricing the calls, you price the butterfly.
Oh, okay. Then do we, so for this question, we also need to price the calls and puts, or do we just use the formula?
I'm not asking you to price it yet.
Oh, okay.
So but I'm asking you to be aware of that relation. Then from that relation, right, you can use it to do whatever you want. Does that make sense?
Yeah, that makes a lot more sense. Thank you.
Yeah.
Yeah, because I was just trying to think of like how time played a factor, and then I got
time plays a factor when, yeah, I understand, right? The word replicate has different meanings. I use the replicating meaning here as in, just copy. And actually, frankly speaking, right, that is a more popular use in finance than the replicate that we think of when we replicate a portfolio,
Okay.
Also, do be aware that the replicating you're thinking of is very, very theoretical. It only holds true on the binomial model. The moment you stay away from the binomial model, that replication you're thinking of doesn't work. So there's no perfect replication for call option with stock and cash, right? I hope Professor Lawson mentioned that. There's no perfect replication. But the replication I'm asking you to do here is perfect. In other words, it's always precise. It doesn't matter what model you use. And that's why there's no time, there's nothing here, right? It works one-on-one. You know what I mean?
Okay, yeah, that makes sense. Thank you so much.
Sure.
Thank you.
Any other questions?
I don't have any more questions, but thank you very much.
Yeah, thank you, Sherry. Yep. See you.
I would like to stay for a while and listen to others' questions.
Yeah. If you have any questions, feel free to ask.